Thanks everyone for being here on this beautiful day, taking time out to hear about where the energy world is headed, and thanks to all of you watching online as well. My name is Jason Bordoff, professor here at Columbia School of International Public Affairs. I direct the Center on Global Energy Policy. And I'm really delighted today that Adam Sieminski, the administrator of the Energy Information Administration, has traveled from Washington to be with us and to present the new annual energy outlook from EIA. All of us in the energy world know the AEO is a closely watched document for getting a sense of how the energy landscape is shifting and what the outlook is from EIA's perspective for where the energy world is headed. And really, given how quickly things are changing, including with the oil price drop, but many other ways as well, particularly interested to hear what Adam has to say today. By way of a brief background, Adam was sworn in June of 2012 as the 8th administrator of the EIA after receiving confirmation by the United States Senate. Before that, he held the illustrious position of Senior Director for Energy and Environment on the staff of the National Security Council. I say illustrious because it's the same position that I was fortunate enough to have in the first term of the Obama administration.
Jason followed me but did a better job.
Adam came to government, to the White House and to EIA from many years at Deutsche Bank, where he was one of the leading energy economists really in the country looking at commodity markets. He was the chief energy economist for Deutsche Bank from 2005 to 2012, and from 98 to 2005 was director and energy strategist for Deutsche Bank's global oil and gas equity team. Long history of affiliations with various think tanks like CSIS, other universities like Johns Hopkins SAIS and elsewhere, former president of the US Association for Energy Economics. And really, I would say about Adam, for those of you who don't follow EIA as incredibly closely, just has been one of the most innovative and visionary leaders EIA has been fortunate enough to have. He's leading the analytic arm of the US Department of Energy at a time of enormous upheaval, with the US shale revolution happening, with the cost of renewables plummeting, with the global energy landscape changing. And the question was, how do you modernize EIA and keep its resources and tools up to date so that it can reflect very quickly and in a rapidly changing environment how the US energy landscape is being transformed. And so we've seen Brent, not just WTI, come into the markers that EIA uses. He revived the International Energy Outlook. Who would have thought we'd have to track data if you want to understand energy for the greatest innovation of the 19th century, the locomotive, but we need to understand rail movements now to understand the oil market, and he's brought rail data into this. The drilling productivity report that's now closely watched, increasing the number of states included in the natural gas survey, bringing oil into it, including by different API gravity types, and a coal data browser that's actually a very useful tool to understand what's happening in the coal market and a host of other innovations. And just on top of all of that, I can say personally, he's just a wonderfully kind and generous person who has taught me a great deal over the years. And I always consider myself lucky to get to spend time with Adam, and I'm lucky that we have him here today. So please join me in welcoming the EIA Administrator, Adam Sieminski.
Jason, that was really nice. You know, one of the other things that we just launched that is really useful, a great tool for students or analysts who want to update spreadsheets that they have with EIA data, is we have a Excel add-in tool that allows you to automatically get the latest information of our thousands of data series on energy. So with one click of a button, you can get the most recent information into a spreadsheet that you've already built that has your graphics in it and so on. And that's really tremendously helpful, I think, to people who want to update their spreadsheets as new information comes out. So that is in beta, but it's working pretty well. And it was, we worked in conjunction with the St. Louis Fed. So you have US economic data as part of what's available with that Excel add-in tool. And so if you want to compare how energy is doing relative to the economy. It's just very easy to do. Okay, so what I'm going to do is talk mostly about the annual energy outlook. This is our flagship every year publication on the U.S. Energy outlook. I'll throw a few things in here about what's happening globally. I think I can do this in half an hour, and then we'll just I'll answer questions until Jason gets the hook out and drags me away. Okay, so let's just go through some of the key results of the annual energy outlook. The U.S. becomes a net energy exporter, perhaps, but our imports go virtually to zero and end sometime by 2030. I think the actual date in the forecast is 2028. When you look at how the decline takes place, a lot of it is between now and the early part of the 2020s, so it could even be sooner than that. That'll be the first time since the 1950s that the U.S. Becomes a net energy exporter. So Jason is absolutely right in what he said. The dynamics in the energy situation in the U.S. have changed very, very dramatically, and for the most part it's happened in the last 10 years and maybe even in the last 5 years. Extremely strong growth in domestic crude oil production from oil shale formations, and limited growth in domestic demand. We might actually be a net exporter of petroleum in total. The amount of our domestic liquids consumption, oil liquids consumption, which had been 60% in 2005, is now down to about 30%. Could be, in our reference case, 15%, might be lower. By 2017, we'll be a net exporter of natural gas. Some of that is going by pipeline to Mexico, but an increasing amount will be going out in the form of liquefied natural gas, or LNG. Meantime, we're having all of this growth in production. In the meantime, U.S. energy consumption is growing at a modest rate over our projection period out to the year 2040, largely as a result of improvements in energy intensity, better appliances, fuel efficiency standards for automobiles. Technology is improving very dramatically in many areas, and law and regulation is pushing that as well. Renewables likely increases its market share of electricity generation over our forecast period, and that reflects a combination of modest increases in natural gas prices and high capital costs of new coal and nuclear generation capacity. This annual energy outlook, or AEO, like all of our major documents, is based on existing law and regulation, and the EPA Clean Power Plan is not a part of existing regulation. It's proposed, but it hasn't been implemented yet. If it were to be implemented in its kind of proposed form, it would make a difference to the coal and renewables numbers, and we'll have a report on that actually out sometime, I think, later this month. Final comment, improved efficiency and consumption and a move away from carbon-intensive fuels has dramatically lowered U.S. carbon dioxide emissions, and they should remain below the 2005 level in almost all cases all the way out to the year 2040. So the U.S. was not a signer. We never did approve the Kyoto Treaty, but our performance in reducing greenhouse gases, especially carbon dioxide, has been pretty strong. So let's just take a quick look at some of these different ideas in the AEO. One thing is we usually don't show comparisons against the prior year's AEO, but in this one particular case, I thought it was useful to talk about it. The oil prices dropped very dramatically, so instead of having oil starting at $100 and moving up over time towards $150, we now have oil starting closer to $50 or $60 a barrel. and moving up, eventually by the year 2040 getting back to last year's forecast, but that gap in the middle has a lot of implications. We'll talk about some of that. Here's a overview of U.S. primary energy consumption by the different fuels. You can see that although we have oil's market share going down, it's still fairly strong. Coal's market share stays relatively flat under existing law. Renewables and natural gas gain somewhat, but not huge gains. It's actually very difficult. This is like a big cruise liner, or the example used to always be oil tankers. It takes an enormous amount of time and effort to actually change the direction of something with a lot of momentum in it, and the U.S. energy system has a lot of momentum. So despite strong growth in renewables and natural gas, we're still going to have quite a bit of coal, nuclear, and oil in the year 2040 as a base or reference case. If you zero in a little bit on this idea of net energy imports declining, you can see that dark black line going down and hitting zero as you get out towards the end of the next decade. What I said in my quick summary was that a lot of the drop actually takes place between now and the early part of the next decade, and it's possible, depending on circumstances, that you might actually see it cross, as we do under the high oil and gas resource case and the high oil price case, where the U.S. becomes a net exporter. We also track carbon dioxide emissions from energy-related activity. And here's the one that says that in the reference case, the numbers come up a little bit over the course of the next few years because of population growth and economic growth, but never really get back anywhere near that very high level that you see back in 2005, 6, and 7. Even under the high economic growth case, with a lot more fuels being consumed because of greater economic growth, you don't get back to that 2005 level. This also points out that a low economic growth would result in a lot less carbon emissions because demand would be slower. I think we can all agree that that's probably not the way we want to achieve lower carbon output. So let's talk a little bit about oil, then I'll look at natural gas, and I'll finish up with some comments about electricity, and then we can do questions. So on the oil side, this goes back to early 2014, and the point was to say that oil prices actually began to come down in the summer of 2014. The OPEC meeting in November of last year was kind of like the final straw that took oil down, but there were three big developments back in the summer of 2014 that really mattered. The first one was a lot of Libyan oil came back onto the market, and that surprised everybody because the governmental and social situation in Libya was bad, and the expectations were that it was going to be some time before oil recovered in Libya, and they had a period of several months where production came up by quite a bit and came into the markets, and it was helped oil prices begin their descent. The second thing that happened in the summer was we began to get the first indications that the economy in China was slowing down. And China alone is accounting for about half of the growth in most people's oil demand forecasts. So with China's economy slowing down, the expectations were that oil demand itself would slow down, and it would be significant, and that helped oil prices to fall. And the third thing was the dollar. The U.S. economy continues to be one of the strongest in the world. That has improved the prospects for the U.S. dollar. So after a decade of declining value of the dollar started to rally, and increases in the value of the US dollar historically have been associated with weakening commodity prices. So things that are commodities, global commodities that are priced in dollars, including oil, natural gas to a certain extent, but oil for sure, gold, and even some agricultural commodities began to weaken in the summer. So a lot of that, I think, really kind of all piled on. And then the OPEC meeting, when the Saudis said they weren't going to cut alone, made a big difference to the oil price. So one of the other things, and it's not shown here, but let me just mention it. I've been doing oil analysis since the early 1970s. This is the 6th time in my career that oil prices have collapsed. So it's not like this is something new. Oil is very volatile. I'll show you another depiction of that in a little bit. But oil is very volatile. It goes up, it goes down, and it's not easy to call. I've made a career out of trying to predict oil prices, and thank God I've had other things to talk about, because if that was the only thing in my career, it would have been a short one. I just bring this up as a way of suggesting to you that the possibility that oil prices are going to go back up again at some point is probably pretty strong. In many cases, people who were involved in the oil business think of low oil prices as bad. We stopped drilling oil wells. People in the oil business begin to lay off rigs and employees. But there is an upside to this. Just based on the drop in crude oil prices and the impact that that's had on gasoline prices, which are now selling for closer to $2.50 than $3.50 per gallon. The average American household is going to save something like $700 or $750 in 2015 relative to 2014. And that's another positive for the U.S. economy. People have more disposable income, and figuring out what people might do to spend that money is an interesting thing for economists to talk about. I mentioned that oil prices are very volatile. I got asked at another university a few days ago whether EIA had predicted the drop in oil prices, and I said no, we didn't, but we did publish information back in the summer of 2014 that said that in order to get a 95% confidence level around the sort of base case that the futures and options market shows you for oil prices, and that's those dotted blue lines that you see coming off the summer of 2014, that you would have to have a range of oil prices that was as high as $125 a barrel, possibly as low as that dotted blue line got at the end of 2015, down near $60 a barrel. So here's a question for a bunch of bright university people. Have you ever heard of the Black-Scholes algorithm, Black-Scholes equation? Anybody? Raise your hand. Black-Scholes. Yes. About a dozen people have heard of Black-Scholes. So there was a Nobel Prize given for Black-Scholes. It's a mathematical way of looking at using the options market and volatility to try to predict the prices for options. So the question that Black-Scholes were addressing was, Black and Scholes were addressing was, are the prices for options efficient or not, and can we somehow compare what the actual prices are to a calculation based on what volatility is telling you about? Well, we had some fairly smart mathematical statisticians at EIA who said, you know, we can turn that around and run Black-Scholes backwards. If we assume that the options prices for West Texas Intermediate, WTI options in the future, if we assume those prices are accurate, we can use Black-Scholes to calculate what the volatility or the implied volatility is associated with the futures curve. And that's what those wings around the oil price in 2014 were telling you, that to capture a 95% confidence range, knowing what we did at that time about the options market, that prices could be a lot higher, a lot lower. Right now, the options market is saying that to get a 95% confidence level on a $55 WTI price, that you need to go as low as about $30 over the next year and a half, possibly as high as $100 plus. It's a huge wide range, and this is not EIA telling you this. This is not some economic or oil consultant telling you that oil could be high or low. This is the options market with people in it who are trading and putting money at risk, airlines, refiners, hedge funds, and others. And this is just a way of saying, trying to make your living predicting oil prices is really hard. Okay, what could drive oil to $110 a barrel? What could drive oil to $30 a barrel? Well, one of the things that could make a big difference is how the nuclear negotiations with Iran work out. If a deal is signed and we get a completed deal this summer, it's possible that 1 million barrels a day of Iranian oil could come back into the market. Probably wouldn't happen all at once, but the markets won't be waiting around trying to calculate the exact day. They're just going to say 1 million barrels a day on the market is going to bring the price down. If there is not a deal, it's possible that the sanctions could actually get tougher and that it would be harder to get Iranian oil into the market, and that could make prices go up. The other possibility is difficulties in oil-producing countries. Russia is under a lot of pressure because of low oil prices, and yet they're still one of the world's 3 largest oil producers. The US, Saudi Arabia, and Russia vie for the top spot in oil production, depending on how you count it. The situation in Venezuela, both government, inflation, the economy, the social situation is very difficult, and yet Venezuela is still producing something over 2 million barrels a day. There's about 800,000 barrels a day of Venezuelan oil that comes to the United States. If that oil were to be lost because there was social strife and strikes in Venezuela, it could drive things up. What happens if we find out that the Chinese economy is not doing? We already believe, most people do, that believe that the Chinese economy is slowing down, but what if it gets worse? That could remove even more demand from the global oil markets and send prices down. So lots of reasons why oil prices might go up or down. So what we do in the AEO is we try to explore a range of prices in different scenarios. We have a high oil price scenario, a low oil price scenario. We have a high oil and gas resource scenario, and we have our reference case. In some years, we even run more of these, and we would include high economic growth and low economic growth scenario. There is value in long-range forecasts, even though, if there was government officials, and I know from my days as a financial analyst, they're not supposed to make guarantees, right? No guarantees. But I guarantee you that our forecasts for the year 2040 are probably wrong. Right, okay, so then I didn't hear the cat call comment from the audience. Well, then why do you do that? Why are you spending our taxpayer money making forecasts for the year 2040? The value in doing this is you run a reference case, existing law and regulation, and your best guess is about the economy and so on. And then you run side cases against it, and you look at the delta, you look at the difference between the side cases that you run in your reference case to try to learn what that means. How sensitive is it to changes in the economy? How sensitive is it to changes in expectations for the resource base? How sensitive is it to high oil prices or low oil prices? You can do all kinds of things. Last year we ran a sensitivity case on what if you had a carbon tax? What does that do to the fuel mix in the US against the reference case? And it's really useful to policymakers to be able to understand that. Okay, so look at this. Jason and I were talking about this earlier. The difference between the high oil and gas resource case and the low oil price case against our reference case is enormous. In the low oil price case, in our reference case, we get up to about 11 million barrels a day of production. That's 1.5 million, million or 1.5 million higher than where we are now. And then it kind of plateaus, comes down slowly. In the low oil price case, we get up to about 10 million barrels a day, and it comes down a lot faster. In the high oil and gas resource case, it's very possible that U.S. oil production could get to 17 million barrels a day or better. And it would have enormous implications for things like oil exports, our economy, fuel mix, and many other things. Here's an example. If under existing law, you can only export crude oil to Canada and under limited circumstances in a few other cases, then under the high oil and gas resource case, with that huge increase in crude oil production, we'll have an enormous increase in the amount of petroleum products that we export into Latin America and Europe, and it would create some really interesting competitive disadvantages for refineries in Latin America and Europe relative to the U.S. The low oil price case basically suggests that exports of products would not be nearly as robust as they would be under even our reference case scenario. A lot more of oil products would simply be consumed domestically. We try to show here the combination of tight oil production and higher fuel efficiency. So that's basically all the shale oil coming in, combined with the fact that fuel efficiency in automobiles and other uses is driving demand down, results in a dramatic shrinking of net exports of net imports of oil. That's the 60% dependence on oil imports that you see, the big wide part of the dark ink at the top around 2005, shrinking down to about a third of our consumption in 2013 and projected to be 14% in 2020. So even under the reference case, the growth in tight oil production and in natural gas plant liquids production, which gets counted as an oil equivalent, really shrinks the level of imports coming in. That's one of the reasons why the dollar has been so strong. The overall net liquid imports under different scenarios in the low oil price case, because you don't have as much production and demand is a little bit higher, low oil prices lead to more demand. You have the worst performance in terms of improving the oil import situation. Reference case gets better out to 2020 and then kind of goes flattish, but the high oil price case and the high oil and gas resource case, the U.S. becomes a net exporter of all oil, total oil, and it happens shortly after 2020. And that's not that far away, 5 years away. What's helping that along is the fact that motor gasoline demand is shrinking. A lot of that is because of fuel efficiency standards for automobiles. It's also being helped by, some gradual movement in getting electric gasoline hybrid vehicles and even all electric vehicles. Diesel fuel, we think, because of continuing economic expansion and the need for trucks to haul material around, continues to grow. Jet fuel grows because more people means more flying, but gasoline consumption shrinks a lot, and ethanol kind of holds on to its market share, grows a little bit in percentage terms. Where is a lot of the growth in oil production coming from other than the U.S.? We see continuing growth in places like Canada, maybe even Mexico, now that energy reform is been approved in Mexico. It could make a dramatic difference. 2 years ago, when we had projections for Mexico, their production we expected would continue to fall. They changed the legal system to allow foreign investment in Mexico's oil, and that could make a dramatic difference to the production outlook. Brazil's numbers should go up, Kazakhstan's numbers should go up, even Russia, we should see long-term growth in oil production. One of the interesting things about Russia is the sanctions, because of the Ukraine, could actually have the effect of slowing down long-term growth in Russia. It's really important that EIA continues to look at the international oil outlook because almost all of the growth in oil demand over the course of the period out to 2040 is occurring in the non-OECD Organization for Economic Cooperation and Development. These are the less developed countries. The growth is in China, it's in India, it's in Latin America, it's in the rest of Asia. It's not, for the most part, the United States, Canada, Mexico, Western Europe, Japan, Australia, and so on. And it's, as a consequence, EIA, in our dream scenario, if there were to be more money available for EIA's budget, we would probably do even more work than we currently can do in the outlook for international energy, because it's going to be very important. This is just a further breakdown of where you see consumption taking place, and those green areas at the bottom, China, the dark green, the rest of non-OECD Asia in light green, growing very rapidly. Okay, a couple of comments about natural gas and electricity, and then we'll stop. Natural gas volatility, this is the Black-Scholes calculation for natural gas. And what that shows is, you know, if you start off with the assumption that natural gas is going to be about $3 a million BTU, and then you want to know what's the 95% confidence level around that. It's, you know, in rough terms, $2 or so to the downside and $5 on the upside. There's looking at the volatility calculations, there's more upside on natural gas prices than downside, but again, it's a wide range for a lot of the same reasons that you see this in oil. Weather can make a big difference, policies can make a big difference, the resource base can make a big difference. There's a number of different things that can move those gas numbers around. We do believe that over the longer period that we'll see gas prices moving up, but in the near term, things like storage of natural gas, very, very important, and we started off 2014 with very low storage numbers for natural gas because of the incredible performance of the Marcellus formation in Pennsylvania. Production for natural gas caught up, and there's an empty seat right over here, sir. There we go. Okay. Storage recovered. We're going into the storage season this year looking pretty good. So in the short run, natural gas prices probably have a good chance of staying fairly moderate. We do look at, like we do for oil, we look at a wide range of price, economic and resource cases for natural gas. This shows prices moving up towards $7 or so a million BTU in the out years. That kind of price will actually tend to limit growth in natural gas consumption. But if oil prices were to go to the high end of our oil price range, it would probably pull natural gas prices up with it. The high oil and gas resource case, as almost always in these projections, gives the lowest prices. There is some comfort there for anybody that studied economics that more supply leads to lower prices. Our forecast for production climb consistently over time. We think that the resource base, so this is in contrast to oil, which in the reference case goes up and then kind of plateaus. Case of natural gas, because we think the resource base is very strong, production just continues to grow over the entire period. Where is all of that gas going to go? A lot of it goes into industrial activity. It's probably the area with the greatest growth under existing law. Electric power, using natural gas to generate electricity, also grows quite a bit and would grow even more if the EPA Clean Power Plan were to go into effect. There is some growth that we see for natural gas and transportation. Some compressed gas in light-duty cars, possibly LNG, liquefied natural gas, in heavy-duty trucking where you have the ability to have bigger tanks. Same thing would be true for rail. We're moving a lot of material around on the rails, and it's possible that liquefied natural gas could end up being a fuel for railroads. One of the things to keep in mind is lower oil prices lowers that spread between the difference in the natural gas price and the price for things like diesel fuel and gasoline. So lower oil prices tend to make it less likely that natural gas gets used as a vehicle fuel. This is one of the other areas where there are enormous differences in the projections depending on which of the cases that you look at. Projected exports of natural gas, pipeline exports to Mexico, or liquefied natural gas exports from the lower 48 states. In the high oil and gas resource case, those numbers go up to almost 16 billion cubic feet a day by the time you get to 2040. In the low oil price case, you get up to about 11 or 12 billion cubic feet a day, and that's pretty much it. One of the interesting things is that most of that difference is because of what happens to LNG exports and not pipeline exports that are going to Mexico. Pipeline exports to Mexico, because of the shorter distances from places like Texas into Mexico, are likely to be done even in a low oil and natural gas price scenario. Some comments on electricity. Electricity used to grow at well over what the economic growth rate was. So what you see in this graph is the annual growth in electricity use in blue and the annual growth in the economy in red. So in the 50s, 60s, and 70s, electricity use was growing faster than GDP. In the 80s and 90s, it was growing at about 1 to 1. And in our forecasts, electricity demand is only going up at about 0.8% per year when the economy is growing at 2.4% per year. So growth in electricity blew out in the forecast period below 1%, while the economy is growing significantly more than 2% per year. One of the interesting things that this causes is it makes it harder for renewables to come into the system. Renewables would grow faster if electricity demand were growing faster. Renewables, in a sense, have to compete against base load things like coal and nuclear and natural gas, rather than competing at the margin for growth in power in general. So this is one of the unintended consequences. Improvements in things like appliance efficiency, better refrigerators, better water heaters, better set-top boxes on TVs, better lighting efficiencies, all of that has reduced the overall growth in electricity consumption, making it somewhat harder for innovative sources of energy to come onto the grid. This is our forecast for generation overall. Coal still providing a fairly significant part of electricity generation by the time you get to the end of the forecast period. Nuclear as well. Renewables grows by a lot. It's up by, not quite, but almost a half. Again, these numbers would be different under different scenarios for coal. If we end up using less coal, we're likely to see more renewables and natural gas on the grid. One of the things that's not in this year's AEO, but maybe we'll look at it again in more detail next year, is what if you were to impose a carbon tax? Last year in the AEO, we looked at carbon tax scenarios, and one of the interesting conclusions is that the more aggressive carbon tax you put on, you obviously end up with less coal because it's the highest of the carbon content of the fossil fuels. But after certain gains for natural gas and renewables, the amount of that can go on the grid, as we currently know the grid and understand electricity transmission and things like storage, it makes it harder to get beyond a certain level, and nuclear power actually it would be a big beneficiary, surprisingly a big beneficiary of a carbon tax relative to other energy forms. Final slide here, and then we'll open up, is that wind is growing pretty strongly in our long-term scenarios. So is solar and geothermal. One of the things driving geothermal is the ability to hydraulically fracture. Geothermal reservoirs can improve the number of places that you can do geothermal energy. So that's one of the positives associated with hydraulic fracturing, is it might make it possible for some alternative sources of electricity generation to come in. In general, we think wind is fairly economic even without extension of tax credits. And that probably means that over the course of our forecast period, that wind will actually surpass the hydro generation by the time you get out to the end of our forecast period. And that's a remarkable development. Conventional hydro, it's hard to make that grow because it's difficult to get dams built anymore. Lots of opposition to that. I did speak with somebody earlier today who said that small hydro projects might offer a surprising amount of flexibility, that some existing dams that don't have hydroelectric power installations it might be feasible to retrofit and get power. Yeah, it'd be an interesting possibility. That's it. This is the advertising page. I'll end up with what Jason said. Please, 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 if you want to know more about a lot of what's happening in energy, sign yourself up for that Today in Energy, the third one from the bottom there. It's current issues in the energy area. We cover all fuels, and we try to focus in on things that are issues that policymakers are struggling with currently. So I think it's fairly useful. Our long-term forecasts are useful too, but some people like to know what's going on today, and that's what Today in Energy is supposed to address. So with that, I will stop. And Jason, shall we sit down at the table, and I'll be happy to answer questions. Thank you.
Thanks so much, Adam. That was a great overview. So many different topics to cover. We have about halfway through, so about 45 minutes for conversation. So we'll sort of divide that time roughly equally. I mean, you and I can talk for a bit, and then we'll open up to questions from the audience, and we have a microphone in the middle. People watching online as well can participate by sending their questions through Twitter to @ColumbiaUEnergy using the hashtag CGEP events. Center Global Energy Policy, CGEP events. And we'll pose your questions to Administrator Sieminski. I want to quickly kind of walk through many different energy sources. But first, I just wanted to ask you to overall help people understand EIA here a little bit better. Can you talk a little bit about what it looks like behind the scenes to put the outlook together that you just presented? How is it organized? How many people are doing this? What sort of analysis do they do to come up with these numbers, which to some people may look like starting here and it kind of keeps growing a little bit over time, and this one grows a little bit over time. But walk us through a little bit kind of what goes in, what kind of analysis, what you're looking at in terms of technology costs and policy and other things go into putting this together.
EIA is, there are 4 assistant administrators. There's the largest group of people at EIA, and about 60% of our budget is actually in data collection. That's one of the groups. Then we have the next biggest group is the Office of Energy Analysis, and that's the group that writes the Annual Energy Outlook, the International Energy Outlook, and a number of our other big analysis products. Today in energy, by the way, Jason, is kind of across the board with literally all of the offices and all of the fuels at EIA contributing to that. The rail data, which you mentioned earlier, is actually a joint product of our data office and our analysis office, with a huge contribution from the Office of Communications in terms of how that data is being presented on the web and your ability to browse through it and do graphics and other things. Even our, what we call our Office of Resource and Technology Management, that does facilities in addition to our big data servers and so on, has been involved in doing lots of things in the energy area. They provide a lot of the computing horsepower for a number of things, including work that we're doing with the Groundwater Protection Council, trying to find ways to collect, with the help of the states, they're a state organization, wellhead oil and gas and water data. So back to your question about the Annual Energy Outlook. It takes nearly a year to put together the annual outlook. There's probably 50 people working on it. And at the same time that we were reviewing the final documents for publication of the AEO 2015, I was engaged in meetings over setting the assumptions for the 2016 version of the AEO. You mentioned the drilling productivity report. One of the reasons that the drilling productivity report, which has much more current estimates for production of oil and gas in the U.S., is that when I got the EIA in the summer of 2012, the 2013 version of the Annual Energy Outlook was already basically cooked in place. And what we realized was shortly into the publication of the early release, we used to call it, of the AEO in December of 2012, the number that we were starting with for oil production was already lower than what we thought the actual was at the time we published it. And so what we've done is we've tried to find ways to integrate the short-term energy outlook, which is published monthly, with the annual energy outlook, and do that in a statistically sound manner, so that the baseline point of takeoff for the annual energy outlook is more accurate and gives a better representation of what's going on. So it's a huge effort to do it, and that's why I like to come back to, well, if you know you're wrong, why do you want to spend all that time and effort? And the answer is those differences between the cases is what you really want to examine. When you look at the long-term forecast, it's not the end points, but the differences between cases that are important.
Great. So I want to ask you about the outlook and also just your broader observations on kind of the energy market as it stands today. And again, let me walk through a couple of different the energy sources we're talking about. Starting with oil, were you surprised by the lack of OPEC action in November, by the new Saudi oil policy, which seems to be to let markets balance themselves and let high-cost producers balance the market? And is OPEC still relevant anymore?
I think OPEC is Saudi Arabia, certainly, and has the linchpin within OPEC, I think is always going to be very relevant and important. One of the things that surprised me, Jason, and I think a lot of other people, was the speed with which events began to unfold. The growth in U.S. oil production from shale and the kinds of improvements that we've been seeing on the consumption side really created a problem in the global oil markets much faster than we thought. One of the interesting things that was in the 2013, in my view, the 2013 annual energy outlook was an examination of what OPEC's market share looked like under different cases in the period after 2025. And what we concluded in there, and you can go back and read this, so we were on record saying that if you had a continuing growth in oil production in the U.S., kind of like the then high resource case, which looks more like today's reference case, and you had a successful return of Iraq to the market, and if Iran should come back into the markets, that there literally was not enough room left by the time you looked at what global oil demand growth was going to be for the Saudis to keep their production at 9 or 10 million barrels a day. So success in Iran and Iraq and in oil shale meant that the Saudis were going to have to give up an enormous amount of market share. So the sad part about this is so we got that right, actually, but we thought it was a problem in the period after 2025. We didn't think it was going to be a problem in 2014 and 15. The technological changes in oil were enormous. So if you come back to, is OPEC still relevant? In the long run, we still need growth in oil consumption to feed the level of demand that we expect in places like Asia, including China, Latin America, and elsewhere. And that means oil is going to have to come from a lot of different places. And we may see prices going back up again at some point to create the incentives for production to occur both in the U.S. and outside the U.S.
And if this oil policy of OPEC and Saudi Arabia continues, we know that the nature of tight oil production means it can go offline and come online much faster than conventional oil. So some people have sort of talked about a call on shale rather than a call on OPEC, or talked about U.S. shale as being the new world swing supplier. Is that the right way to think about it?
Well, it certainly could be. There's no question that oil and natural gas from shale can come into the market and go out of the market faster than big projects in deep water Gulf of Mexico, for example. So if you were to say, how long does that project take? 10 years. Well, how long does it take to, put on or take off a project in shale? Maybe the answer is 10 months. So that's a big difference. It's an order of magnitude. So what I think has always been the case is trying to call the bottom. Like saying that U.S. shale might put a floor on oil prices, I think is true. But just as the kind of miscalculation that OPEC made when they thought that average costs in the North Sea back in the 1980s were, close to $20, that oil would come down to 20 and stop there. Well, this is economics. It's not the average cost, it's the marginal cash cost, and marginal cash costs are probably below $50 in a lot of shale plays. And so the possibility, that graph, that chart that I was showing you about to have a 95% confidence range on oil, you might have to have a $30 number to the low side, might yet come true. If you had Iran come back into the market and China's demand be weak, it's certainly not out of the question that oil prices could go down. Would shale come off? Shale has come off. Our drilling productivity report is showing that for the first time in 2 or 3 years, production is starting to go flat in these big oil shale plays like Eagle Ford, Niobrara, and Bakken. The only place that it hasn't gone flat yet is the Permian Basin, but there's still kind of a combination of traditional vertical drilling and horizontal drilling that's keeping those numbers up. So I think the 10-second answer, Jason, is OPEC is still going to be relevant in the long run, and even in the short run, with Saudi Arabia still producing 9 or 10 million barrels a day of oil, they're critical suppliers in the global oil market.
And how quickly, just to close on that, could U.S. production come back if prices were to spike back up into the 70s or
Well,
beyond?
there are some people that think that,
and how much do we know about
wells have been drilled but
Yeah.
not completed. You know, there's sort of two stages. You drill the well, and then the completion includes doing the hydraulic fracturing and, you know, putting the control mechanisms on at the surface. Doing all of that, it can be separated, and completing a well is probably 60% of the cost. So there are some indications that wells have been drilled, but basically parked and left idle, and those could probably come back very quickly, you know, possibly over, you know, something that would be measured in less than a year.
And last question, so on this topic, there's a lot of discussion about the impact of the oil price drop on shale. The focus seems to be on shale on the supply side, but look outside of shale, the impact it has on deep water and offshore, the impact on Arctic. Should we be as focused on shale as we are, or do you think the impact, maybe not as in the near term, but over a little bit, a couple more years,
the
is going to be much more?
Right, the rig count in the U.S. has collapsed, even globally. The amount of drilling that's taken place has come down. You know, I would say that for oil-producing countries, you know, and OPEC, start there, you know, Russia plus major OPEC countries, it's created a real economic issue for them. You know, the revenue stream has come down very dramatically, yet in many cases, the cost side of a country's national budget is a lot harder to move, and it's put enormous stress on countries like Nigeria, Venezuela, and others, including Russia. Saudi Arabia, too, has lower revenues, but the Saudis, among others, have an enormous level of savings, in a sense, an asset base, which would last for quite some time, even with prices where they are now.
And how, switching to natural gas, how's the outlook for gas supply, demand, and trade, both in the U.S. and outside the U.S., been affected by the oil price fall?
In many places in the United States, natural gas and oil compete in a sense in separate markets. So natural gas largely going into the industrial and electric utility markets, and oil isn't playing there. So the market for natural gas in the U.S. is really separate from the market from oil. They interact when you look at the spreads, or they interact in the U.S. when you think about, can you use natural gas in a vehicle in some way, either compressed gas or liquefied natural gas, or converting the gas into a liquid fuel. Outside the U.S., there's still a lot of competition in the electric utility area between oil and natural gas. And as a consequence, natural gas outside the U.S. tends to be priced at an oil equivalent. It's true in Japan, it's true in a lot of Asia, and it's true in Europe. So when you think about the impact of lower oil prices, it's also brought natural gas prices down, which means that projects designed to export U.S. natural gas into waterborne markets outside of the U.S., the economics have changed pretty dramatically in the past year. And what we might end up getting out of this is less U.S. natural gas exports. One of the things that EIA did look at was, well, what would the effect be of exporting natural gas on domestic prices? And what we found was it would raise domestic prices for natural gas, but by a modest amount, maybe 5%. And in contrast to oil, we looked at the economics of exporting crude oil, and our conclusion there is that it would probably not raise domestic crude oil prices. If anything, it might lower crude oil prices, because more crude oil on the global markets would reduce Brent crude oil prices, which would lower product prices in the U.S. and, could end up putting some pressure on prices in general. So an interesting difference between exporting LNG and exporting crude oil is that from a consumer standpoint, exporting crude oil might actually lead to lower prices for things like gasoline and heating oil.
So that's obviously been a topic of much conversation recently in policy circles and elsewhere about the oil export issue. I guess EIA recently put a study out about the refinery capacity to absorb more light oil, finding that many of the low-cost options to do so have been used. So how pressing a concern is this? How big an issue might we see develop if policy remains what it is?
Well, we're continuing to look at this, and we'll have 2 or 3 more studies out over the course of the next month or two. One of the general conclusions that we're coming to is that technically there are lots of ways to change the U.S. refining system to run these lighter type oils that come from shale developments, but it's at a cost. And in order to provide refiners with the incentive to make changes, particularly the more sophisticated kinds of changes, you'd have to have a larger gap between world oil prices and U.S. oil prices to provide the incentive. And that's one of the things that I think policymakers would have to take into consideration in looking at the issue of changing the rules on crude oil exports. If you don't change those and we get more oil production, then you get that graph that I showed Jason, where we'll just export more products because the products can be run. But that too, there would be certain financial implications associated with that because in order to continue to run more products, refiners would have to make changes in their configuration, and that requires capital investment, and it's not free.
So let me move away from oil and gas before we open it up. The renewable costs, the costs of solar have come down remarkably quickly. You showed modest growth in renewables. I mean, a rapid growth rate, but obviously still in the long term, it's still a small share. And you explained part of the reason for that was we're just not adding a lot of new capacity, so you're competing against existing installed baseload. You see a lot of different estimates and numbers about how competitive renewables are. Some people saying they already compete on their own, and others that it still requires government support and takes a lot of time. How should we think about the competitiveness of where solar and wind are, given how quickly costs have come down?
Well, wind is, as you see from the growth that we have in our reference case, which includes the sunsetting of the tax credits for wind and solar, wind does grow quite a bit. So wind is getting competitive even without federal subsidies. Solar doesn't grow as fast without the subsidies. We will next year run no sunset cases. So no sunset means the tax incentives for wind and solar are continued out into the future rather than ending as they do under current law. And in those cases, you tend to get bigger growth. The thing that I believe is the hardest thing for EIA or anybody to do is to know really well what the technological breakthroughs might be. We probably, even in wind, if you had better storage, if you had batteries that worked, wind and solar, both of which are intermittent, would be far more useful onto the grid because you could store the wind power at night and put it back into the grid in the day. With solar, you'd be able to even out the loads depending on what weather conditions were and so on. Beyond that, just the costs of solar voltaic panels have been coming down, and the technology there, how many watts you can get out of a panel has been improving very dramatically. We have some of that built into our long-term forecasts, but if somebody comes up with a magic way of dramatically improving the efficiency of solar photovoltaic panels, it would make a big difference to those numbers.
And on that storage question, what did you make this week of, the announcement by Elon Musk about like selling residential storage units? Is that the sort of first step in the kind of technology shift you might be talking about?
Yeah, I mean, I think that experimenting with things like electric vehicles, and Tesla has been doing that, is how we get things done. You start experimenting, then you try to move it into the mainstream. I think with batteries, the numbers that Tesla made available in their press conference on that basically are the cost of the battery itself. It doesn't include installation, and it doesn't include the inverter that you would need in a household to turn DC current into AC current. So the costs would be higher. California has been experimenting with distributed generation and batteries, and it's still fairly expensive. So I have a feeling that kind of like electric and even hybrid vehicles got their start with people who, for lots of different reasons, wanted to be kind of the first to have an electric vehicle. I suspect that the initial markets for Tesla's battery systems are going to be people who just like the idea of not being dependent on the grid entirely. One of the other tricky parts of the Tesla thing is that if you're in an area, and California is an area like this, if you could store electricity from solar panels on your roof in your battery, and then feed that into the grid when the time of day rates were the most advantageous for selling electricity into the grid, that would make a lot of sense. Most states still don't have time of day pricing for residential units, and so that would tend to constrain the market.
So, and last question for me, how you didn't show.
Jason, hold on a second.
What's that?
Elon Musk's partner and chief technology officer, Struble, is going to be at the EIA conference June 15th and 16th in Washington. And you can ask him that question if you come to the conference.
A great conference. Everyone should go. Can you watch it online as well?
I think parts of it.
Okay. The emissions, I don't think I saw, but maybe I was, the emission projections. So in the reference case, how much is the reference, how close, what do emissions look like under the reference case, and how close is that to the 17% by 2020 and 26 to 28% by 2025 targets that the U.S. has announced?
All right, so those targets are for greenhouse gases in general, and what we track at EIA is not overall greenhouse gases, but carbon dioxide from energy-related activities. So we don't even have carbon dioxide, from non-energy related sources. The targets that the president set have a lot of different parts to it, and include many different greenhouse gases, including things like methane. And so it's really hard to do a one-to-one comparison. If you come back to what EIA has said about energy-related carbon dioxide emissions, they climb a little because of both economic and population growth in the U.S. But in general, in our reference case, the numbers stay well below our 2005 levels. One of the things that tends to make those numbers climb over time is that existing law for fuel efficiency standards for automobiles basically plateaus in 2025. If we were to make the assumption that fuel efficiency standards for light-duty vehicles would continue to improve after the 2025 period, those carbon dioxide emission numbers would come down, and could come down fairly sharply, actually, from the reference case.
And those numbers in there include the EPA power plant rules or not?
They do not.
They're not, right?
And
okay.
we will have a study on the implications of the clean power plan out later this month, I hope.
Great. There's a microphone in the aisle, so if folks who want to ask questions could please step into the aisle and stand by the microphone. We will take the questions in order. If anyone wants to. I think one person getting up. And we have until
Thank you for being the first
7:30.
other than Jason. Please.
Okay,
And if
thank you.
could introduce yourself and keep your questions brief, please.
Thanks. Okay, Lindsay Ashby with the World Energy Forum, and this is just sort of piggybacking on Jason's question on renewables. There were a couple articles by Reuters and Bloomberg last fall talking about an EIA estimate about 2050, about half. The number one source for electricity would be solar. I'm seeing wind kind of flash up as sort of the more, I guess, source. I don't know. It seems to be exceeding solar.
Right.
Is that because of a recent breakthrough, or do EIS estimates sort
So
of?
that's because under existing law and regulation, with the tax credits expiring, wind is more economic than solar, given what we now know about the technology. So wind grows more than solar. If we get improvements in solar technology beyond what we've built in, those numbers could change. If the Congress were to allow tax credits and solar to be extended beyond the time frame that they currently have, that too would make a pretty big difference to the solar numbers.
Great. Okay. Thank you.
Yeah, please, next question.
Hi, Albert Golson, Indo-Brazilian Associates. Could you comment a little bit more on the logistic aspect of oil in the United States? We're heavily dependent now on railroad transportation, but I know the government has imposed additional safety precautions with respect to making the tanker cars more robust, and it probably hasn't turned out to be as robust as most people had anticipated. In addition, I think there are additional regulations with respect to the speed of the rail cars, as well as possibly application of new types of brakes for safety concerns. To what extent would the limitation of, let's say, railroad transportation have with respect in production as well as pricing?
Right. So we haven't actually tried to study the implications yet of changing the rail car rules. It's probably something that we will get to once those rules are final. The one thing that we have started to do, I think Jason mentioned very early on, is for the first time now, EIA is providing monthly data on crude by rail movement. The overall level of crude being moved by rail in the U.S. is now up to over 1 million barrels per day. So that's a lot. And a lot of that is going to the east coast of the U.S. Some is making its way to the west coast, Oregon, Washington, maybe even into California. Some actually works its way down to the Gulf Coast of the U.S. The Bakken is the origin of a lot of the oil, the bulk of it, but there's oil even coming out of places like the Niobrara and the Permian Basin that's moving by rail. Part of it is an infrastructure issue. The oil growth in the Bakken was much faster than typically has occurred in the past, and pipeline permitting is difficult in almost any circumstance, and so it's just made it more difficult to get pipelines built, and as a consequence, rail, which doesn't require the same level of permitting, has happened. On the issue of what the new requirements would do, one of the things that you didn't mention is the capacity to actually build new rail cars, and whether you can build enough, whether the growth in the ability to build the cars matches the growth in production. So there's all kinds of things, moving parts in that. It's pretty complicated. So you have to know a lot about the rail transportation networks. You have to know a lot about refining capacities. You have to know a lot about the ability to get pipelines built. Even there have been proposals to move some of the Bakken oil to places like Minnesota, Wisconsin, and so on, and getting those permitted has been difficult. So I think it's a great question, and I'm sure the EIA staff who are watching this are kind of going, "Oh no, we just got another assignment," but it's something that we should take a look at.
And for those who don't know, those rules were finalized this week, and so the rule from the Department of Transportation has a lot of their estimates about the capacity that we have for new tank cars and new brakes, the impact of reduced speed limits on congestion, and I think you have somewhere between 3 and 5 years to make these changes.
And it was done in conjunction with Canada too, so Canada will have the same set of rules. There's quite a bit of rail traffic between the US and Canada, and that's on our website too.
Next
Thank
question,
you.
please. Thank you.
Hi, Ed Camp from ShaleNavigator.com. I've got a question on your projections for natural gas consumption growth. There was a slide. You had about 5 different markets, and there was industrial activity, commercial, obviously residential. What is the difference between industrial and commercial in those markets?
Yeah, I mean, you can find the answer to that on our website. It usually tends to revolve around what the use of the facilities are, and commercial tends to be more, let's just say, retail oriented, and industrial is more manufacturing oriented. There are some places where they cross over, but commercial includes big office buildings, malls, schools, hospitals. It's not residential, but it's not manufacturing. And the one that you forgot, which is one of the big growers, is using natural gas for electricity.
Right. Now, so a quick follow-up question on that. The different shale plays will have different markets, primary markets for the product. Bakken will be different than Marcellus just because of different demographic and urbanization.
Right.
Are there any plans to break it down by shale play, these 5 segments?
Yes, as a matter of fact, we are starting now to collect data. We haven't published it yet, but we're collecting data from 15 states now rather than 5. So Pennsylvania, West Virginia, and Ohio are in the new survey, and they're not in the old survey. As an example, on the oil side, we'll be collecting data from North Dakota and Montana. And we didn't have that in the old monthly oil. In fact, we didn't have a monthly oil production survey, but we will have one, and it'll include API gravity. So there'll be a lot more granular detail in our monthly reports on both gas and oil. If you kind of come back to the thrust of your question, the growth in gas production in the Marcellus has been enormous. It's been very rapid. It's in the east. One of the other things that we're doing this year is in our storage report, we used to talk about the producing region, consuming east and consuming west, and we've now said, well, that's wrong. I mean, there's now producing east. We're just going to talk about regions, and the Marcellus will be one of the regions that we cover in our storage survey. The growth in gas in Pennsylvania and more recently now in Ohio is making enormous changes in infrastructure requirements. There are occasions where gas from Pennsylvania is actually being sold in Louisiana. I mean, if I would have told you that was going to happen 4 years ago, you would have called up the psychiatric department here at Columbia to try to improve my mental attitude. So one of the interesting questions about all this is, will we be able to get pipelines permitted and built from Pennsylvania up into New England? There's an enormous need for natural gas in New England because of weather, because of the fact that they just shut down the Vermont Yankee nuclear plant, because of the fact that pollution rules are getting stricter and stricter. And getting gas into New England has never been easy, and it's now it's a regional thing. It would be fairly inexpensive in one sense, at least from the fuel standpoint. Building pipelines is still time-consuming and difficult, and you don't build pipelines for 1 month of cold weather every year. You need base load, and so it'll be an interesting thing to see whether electric utilities and industrial users in New England will agree to longer-term contracts.
Right, right. Okay, thank you. Thank you, Adam.
Thank you. Next question.
Hi, Hamid Qadusi from Stevens Institute of Technology. I have two quick questions. First, regarding shale investment. Given that the marginal cost of producing from shale is much higher than Middle East countries, and also assuming that the OPEC is committed to sort of suppress the price if the US tight oil goes up, do you think we are entering a new equilibrium in the investment and the behavior of the shale producers within the US, that they would be much more afraid that they cannot continue with increasing price and expecting that it stays high?
So let me see if I can't summarize that. Is oil prices, could go up or down, and OPEC in the past has had occasions where they've caused prices to go higher and caused prices to go lower depending on the actions they've taken. What should a company do? How do you manage investments in that kind of volatile situation? So I started this discussion off by saying that I think I did, if I didn't, in my career since 1971, this is the 6th time that prices have collapsed and we've had just as many price increases. And there's a CEO from one of the big oil companies some time ago when I was a financial analyst and I would go to meetings, and I knew better than to ask this question, but analysts would sometimes go to this meeting and they would raise their hand during the question period and they'd say, "What's your oil price forecast?" And the answer from this CEO was, "We can't control oil prices. We don't know what oil prices are going to be. What we can control is our cost structure. And we're going to be the most efficient company out there. We're going to be the best in class at controlling our costs. And then if oil prices go down, we'll be able to weather through. Somebody else will go out of business before we do." In a sense, the Saudis, I think, employ the same kind of strategy. They have high savings, and that country will remain in business when other countries have big problems. And I think, in a sense, that's the management of the oil markets, in a sense, is in the hands of a lot of different people. It's not just OPEC. It's not just the oil companies. It has a lot to do with costs and technology and other issues. So I think that the quick answer to your question of what happens with investment is it'll move up and down depending on what the prices are. And I think what Jason said earlier is that one of the things that we're going to really find out now is whether U.S. shale can offer kind of a buffer, a downside buffer to oil pricing.
My second question is more methodological about
Keep it brief, please. I said keep it brief so we can get to the final question.
So how to incorporate
And that applies to me in the answer too, right, Jason?
how to incorporate breakthrough technologies into scenarios that you're providing, CCS, second generation biofuels, et cetera, that none of them are commercial in the short term, but they may significantly change the future scenarios. We don't see them in the normal scenarios produced. Of course, you have the bonds, but they are under business as usual, under geological constraints and so on. Is there a next step at the EIA to sort of incorporate them and provide a richer space of scenarios?
Right. So I think the answer to that goes back to what's the value of long-term forecasts. I think the only way that you can deal with that is to say, let's do kind of a standard technological change. Maybe it's incremental, 3% per year improvement in something, 1% per year improvement in something, and run side cases to include breakthrough issues. What if there's a breakthrough in solar? What if there's a breakthrough in carbon capture and sequestration? What if there's a breakthrough in the costs associated with producing the resource base? And you can examine what that does. I don't think that helps you pin down the likelihood of the event taking place, but it would allow you to at least think about what the consequences would be. Thank you.
2 minutes per question. There are 2 more, so please be brief.
Hi, Wahid Sheikh, Moody's Investor Service. You touched upon this a little bit earlier, but I was wondering if you could comment on the implications of having sour crude in the mix as opposed to just when we talk about WTI and Brent, which are sweet crude indicators, but what are the pricing implications on, let's say, Brent or TI of having sour crude in the mix? How much of global production is sour, and how does the EIA factor in the outlook on sour crude when it comes to?
Right. So EIA has made, the first report that we did in this series of trying to examine the issues associated with crude oil exports we looked at production of crude oil by API gravity, which is not exactly sulfur content, but it comes close because the high API crudes tend to be low in sulfur, and low API crudes tend to be higher in sulfur. So we have some guidance on that from the forecast that we did last May. I think this month or in early June, we should have an update out on the growth in crude oil production by API gravity. I also indicated that we're starting to collect information now from the states and producers on production by gravity, so we'll know a lot more about that. One of the interesting aspects of the U.S. Petroleum system as it's currently set is refiners in the Gulf Coast, and that's the biggest refining center in the U.S. Most of the refining takes place in the Gulf Coast of the U.S. Spent a decade and billions of dollars upgrading to run high sulfur heavy crude oil, which they thought they were going to be importing, only to find out in 2013 and 14 and 15 that the growth in light sweet crude oil from the Bakken, from Eagle Ford, from the Permian, from the Niobrara was in a sense having the possibility of bottlenecking the upgrading that they did. So one of the questions now that policymakers are going to be confronting is looking at the crude oil export ban. What has to happen to domestic differentials? How far do domestic crude oil prices have to go to low? Do they have to go to provide the incentive to refiners to change the kit? And we are looking at that and should have a report out in over the course of the next couple of months.
Okay. Very briefly, one final question, bearing in mind.
He is the last person standing, Jason. So
I know.
Rich Berkowitz, Transportation Institute. I noticed from your graphs that there wasn't a dramatic increase in the use of LNG. I know in the industry that I'm most familiar with, maritime.
In transportation.
Yeah, transportation, in maritime and specifically, that we had the first freight ship, U.S. flag vessel that goes up to Alaska from the Northwest, convert or will be converting to LNG, and new ships in Puerto Rico were just announced, the first freight ships. Given that there's increasing expectations for further emissions control standards, it seems like there might be greater use of LNG.
Right. I think, what year is it? 2017?
2015.
Yeah, and it phases in, doesn't it, over time?
For certain vessels, but
the MARPOL. So that we're changing the emission rules for tankers, basically. And there will have to be some interesting, tankers and ships.
Yeah, large
ships.
Of
all kinds are going to have to decide whether they're not going to be able to burn residual fuel anymore unless they put all kinds of equipment on to control emissions from that. So the question is, do they burn more diesel fuel or should they burn natural gas, possibly in the form of LNG? One of the reasons, keep in mind that this is the annual energy outlook and it deals with the U.S. A lot of maritime transportation that would use LNG might be doing so outside of the U.S. Inside the U.S., you have the further complication of something called the Jones Act that requires the ships to be built, flagged, and crewed, all by U.S. entities, and that's more expensive, and it tends to limit the turnover in those fleets in the building. One of the things that I think you have to keep in mind too, is there's so many moving parts in this, is that with lower overall oil prices around the world over the course of the next 10 years, let's say, the spread of LNG to oil prices has been compressed by the drop in oil prices. So it makes it less attractive to convert from an oil-based fuel to a natural gas-based fuel. That's the same problem that LNG is facing in power markets and other markets overseas. We were looking at use of LNG by trains. We were looking at use of LNG in heavy-duty trucks in the U.S. And again, for a truck or a train that's using diesel fuel, if you thought diesel was going to be $4 a gallon, but now it's going to be $2.50 or $3 a gallon, it makes a big difference to the spread to LNG. So one of the reasons that we don't have as much growth as you were asking about is that we have lower overall oil prices in the near term.
Thank you.
I wish we had more time to spend with Administrator Sieminski, but the good news is I heard you say there were export studies coming and an analysis of the EPA power plant rule, and I'm sure much more. So there are many reasons for you to come back to Columbia and spend more time with us, helping us understand the energy outlook and how dramatically things are changing and how to make sense of it. Please continue to follow the center's events, sign up for our distribution list, follow us on Twitter at Columbia U Energy. The center's next event is tomorrow morning at 8 a.m. at the Columbia Club in Midtown with a variety of Columbia experts, fellows at the center, myself, Colin Fenton, Bob McNally, and experts from the business and law schools discussing the oil price drop and its geopolitical, environmental, and economic impacts. And please join me again in thanking Adam Sieminski for being here.
Thank you, Jason.